Hello everyone, I'm Steve Savant, syndicated financial columnist and money color commentator. On today's show, Identifying Asset Classes, part 3 in our series on Understanding Asset Allocation. In our third segment, we're talking about identifying asset classes. There's a little bit more here to talk about. Again, I'm just bringing introduction into our whole idea this week of asset allocation and just kind of giving you an LED version. And when I'm looking at this, I want to look at some of my assets are going to be equity securities. Some of my assets are going to be debt securities or tangible property, maybe real estate or heavy metals. Some of it's going to be cash equivalents, maybe even derivatives, subsets of investments like options. If I wanted to buy options in the S&P, that would be a subset of buying the S&P outright. I want to be able to look at, when I'm doing it, should I have other assets? Should I choose preferred stock? Because it's going to put me in a better position in the company. If things went south, I might get a little bit more up the food chain in order of who's going to get paid what. I want to be able to also look at high yield notes and convertible bonds and floating rates. I want to look at all this, but let's just go through what I call the big 9. And again, this is in our book on asset allocation. You say, Steve, I'd like to have it. I think it's $9.99. Feel free to go ahead and order it at steve@lifesizesolutions.com. Just write me and I'll go ahead and make a transaction for you. Cash equivalents. Debt instruments with a term of less than a year and U.S. Treasury bills, certificates of deposit and money market funds, and one more, short-term annuities. There are short-term 3, 4, and 5-year rates right now that you could lock down. The one thing I do like about that is you don't pay taxes until you actually take constructive receipt of the money. Whereas in CDs, you pay taxes on the money, on the earnings every year, even if you don't use it. So just heads up though, cash equivalents is the first place. If I'm looking to identify what an asset class is, that's the first one. U.S. equities. Well, I'm looking at stocks and companies whose ultimate parent company is incorporated in the United States. Traded options on the U.S. stock and stock indexes are equity-based derivatives. I want to start looking at equities in the U.S. Most Americans are still not global in their thinking. That could be bad, and sometimes there was a couple years back when the Hang Seng out of China was just roaring and people missed out on a huge opportunity. But sometimes people look at other stock markets like Europe, like the Hang Seng. Sometimes the other ones that might come on are third world emerging markets. They're just not comfortable with it. So the vast majority of Americans still right now are utilizing U.S. equities. Another one is non-dollar equities, stocks of companies where the ultimate parent company is incorporated outside the United States. Now, again, it's not bad. They have a United States subsidiary, and most people can be comfortable with that, and especially, generally speaking, if they're big names out of Japan or Europe, as 2 examples. So you want to be able to look at that, and of course, a lot of these are rated. Could be their debt is rated by Moody's. You could go out and see the Moody rating on this. You could look at the S&P rating on it. So mortgage-backed securities. Securities that are backed directly or indirectly by mortgage loans, including participating certificates and real estate mortgage investments. You want to look at this and say, when mortgages are hot, is there a way that I can participate and can become part of the spread and make money on this? Most people want to buy a home. Most people are good about paying their mortgages. It seems to be relatively safe, but it has risks. And after 2008 market meltdown, boy, buyer beware. Real estate that used to be cherished and almost like bulletproof was shown to be completely vulnerable, just like every other investment. So before you get really excited about this, don't forget, 2008, let your memory serve you well. It was really a painful time. Now, short-term debt. Debt instruments with an expected life of 1 to 7 years. Some people like hey, I'm just buying 10-year treasuries. I'm buying a 5-year note. I'm doing stuff that's conservative. I don't want to really buy anything. I got to look at the rating of the bonds. I want to make sure they're investment grade, short-term debentures, or any short-term debt. I want to make sure of that. Long-term debt, all debt instruments that aren't included in cash or short-term debt or mortgage-backed securities. There are long-term debts. Some people like corporate debts. The big names are out there. IBM, Hewlett Packard. They look at the debt service. Now remember, since money is so cheap, not that many people are in corporate debt that much because it doesn't really pay that much. So people are looking at long-term debt. If we start moving up in interest rates again, that could be a play again. Right now, I looked at some 20-year annuity I saw out on the market was barely over 4. Would you lock it down for 4.1 whatever percent for 20 years? I wouldn't. Right now, We think that interest rates are going to still keep ticking up, so I'm looking at CDs and annuities in a combination in a laddering effect with 3, 4, and 5-year maturities. because we're really not going to know where it's going to settle out. And remember, right now, still short-term rates may be the play against long-term rates for a very long time. So just keep that in mind. Another one is the non-debt dollar. Things that have nothing to do with our dollar. All debt instruments issued by currencies outside the U.S. This is a whole nother place to play. Again, this has more risk. We don't have the same regulatory issues in the United States as we do maybe in Europe. You're going to have to sit there and say, can I live with that kind of idea? Do you have more venture capital than investment capital? There's higher risk to do these things. You may want to be, if you don't have comfortability with that and you want to stay in the good old US of A, you probably need not to do this. But if you say, hey, look, I like the returns, I like the currency arbitrage, I think we're making a little bit more even on the currency itself, that could be a play. Real estate. All real estate investment trusts, like REITs, are a big one. They were huge in the 80s and early 90s. Big real estate investment trusts. You may buy regular real estate. Maybe you're a flipper, a local flipper of homes. Real estate, you're buying REITs for a alternative form of income that's not so tied to the traditional equity and bonds in the market. So that's just another asset area that you can go to, a little longer haul, not as liquid. You have to be real comfortable with the REITs, and you have to look at your risk tolerance and say, is that something that I can do? Another one is precious metals. Oh boy. I was trying to stay on the basic issues of gold and silver, and now we're talking about Bitcoin, and who knows where that's going to land out. When you look at those kind of online currencies, I don't know where they're going to be, and I'm certainly not an aficionado to speak to them. But a lot of people like a little bit of heavy metal in their portfolio. They like to have a little bit of gold, a little bit of silver. Some people buy their gold and silver in jewelry. Some people buy it in certificates. Some people buy it with certificates and inside qualified plans. Remarkably. And once in a while, you might get a Kruger or a bar, a small bar that you're going to put in your safety deposit box. Remember, we went off the gold standard during the Nixon years in the 70s. We've never returned to it. We printed more money than you can believe. I feel like we're the United States government of Kinkos. So you got to remember, some people like that gold, that heavy metal of silver. Silver is a cheap man's way to play in the heavy metal market. And those are kind of numbers that you can say, listen, I wouldn't mind having a little bit of that to offset inflation. But keep in mind, you're not going to be going to the grocery store with your little bit of bullion and shaving off a little bit of your bar to pay for your groceries. That's not how it works. So you're going to have to think about what's the liquidity of that bar and how can I get my hands on it if I had to have it. So remember, nothing wrong with it. You just got to know what you're doing. And by the time you're into precious metals, you're into some risk here. So you better understand your risk tolerance and are your goals compatible with buying metals. Think about this. Can you align your goals with these assets? Just think about that in your mind. Are they compatible? Is there synergy here? Is there something that you can look here and say, I feel comfortable? Remember, if I'm looking at things, I'm looking at different ideas. Over here, I might be looking at floating interest rates. I might find out there's some short-term rates that are really remarkably cheap and easy to get to. I might be doing hedge funds. Now you're into serious exposure, but some hedge funds look to try to offset market losses and put themselves in a position so they can eke out a little bit more earnings. And some people like limited partnerships. It could be real estate limited partnerships. It could be business limited partnerships. They're always looking for different ways of alternative investments. Keep in mind that some of the alternative investments that you should be looking at, because they are really ranked in the alternative area, is fixed annuities if you're conservative, and maybe an index annuity if you have a 10-year horizon or more. You may want to also look at cash value life insurance that is designed for the least amount of death benefit to keep the costs down. And then you're going to have 4 different chassis that you get to choose from. Those chassis could be participating whole life, which pays a dividend. It could be a universal life, an index universal life, or a variable universal life. Each one of them have reasons for you to look at it. These are, again, also alternative investments. And remember, if you're getting close to 62, you need to start looking at the home equity conversion mortgage as an asset, because your home could generate tax-free income, and that tax-free income will not be correlated and fall on the provisional income test of Social Security calculation to find out if it gets taxed. So it's really important to have alternatives too: reverse mortgage, cash value life insurance, annuities. Maybe even look at your HSA account as your first funding vehicle before you go to your IRA. It's fully deductible and it comes out tax-free as long as you use it for medical premiums or medically related costs. To me, you'll always use that, and you don't have to wait till 59 and a half to get to it. Deductible, and think about it, you're able to take it out free for medical issues. So when I'm looking at this, I'm now looking at assets, different asset classes, which ones match up to my financial goals. Don't forget to watch our next segment on risk and return, part 4 in our series on understanding asset allocation. And remember to keep in mind before moving forward with anything on our show, always check with your tax consultant, legal counsel, or your financial advisor. You've been watching Steve Savant's Money, the name of the game.
Oh my!